Guys, the housing market is crashing and a crash is coming. So if I were you, I would hold off buying. Now on this video, I want to explain to you why I say that and give you some statistics and some things going on in the housing market that's really going to make you think, guys. We are in a housing crisis. Supply is super duper low. High mortgage rates are a disaster to the housing market right now. Rates are up close to 8%, right? There's also some slowing and some new building going on for builders throughout the country, all over America, whether they're building single families or apartment complexes, right? As you see from this article here, U.S. housing affordability hits worst point in nearly 4 decades. So guys, that's almost a 4-decade low when housing has not been affordable. Federal Reserve needs to lower the interest rates, the federal funds rate. Now, I don't think it'll happen until 2024. Now, what's happening right now is we have super duper low inventory going on all throughout the country, and home prices keep going up. So supply, when I say low inventory, I mean supply is low. There's not a lot of houses out there for sale, and home prices continue to creep up. Now, they're not going up like they were going up, but they're still rising, right? They continue to rise. People don't want to sell their existing homes because of these high interest rates, right? Who wants to sell their home where they're locked in at 3 or 4% for interest for an 8% interest loan, right? People just won't do that. So that's keeping the supply low. So when you say that the Fed raises interest rates and ultimately that trickles down or up to the mortgage rates, then it's hurting people because people are saying we want to hold on to what we have. We don't want to let go of any of these properties because we'll have to buy another home at an 8%, 7.5% mortgage rate, and money costs too much. So there has been a downturn in sales and a continued slight uptick in prices, right? Now think about this also, guys. Foreclosures may be coming soon as well. So there really could be some bigger issues on the horizon. Just be aware of that. Right now, the only people who are moving and relocating are the ones who, and buying new homes are the one, or buying existing homes are the people who have to move, right? They're forced to move. Maybe through job relocation, maybe there's some divorce, or maybe there's even marriages or having kids, or, somebody dies, right? Those are the types of people that are selling their homes and going out and buying new homes, right? Or just buying homes in general, right? That's it. And so it keeps supply very, very low. Existing home sales, typically, guys, they float between, and I'm talking about existing homes, not new homes, but existing homes that are out there in the market usually float between 4 million and 6 million that are available, right, in the market. And during the pandemic, they were up to, I think, 6.5, 7 million. But it usually never gets below 4 million of existing homes that are for sale. Right now, it's under 4 million. I think it's 3.7, 3.8 million available homes for sale. That's an issue with supply. Very little supply out there. So existing homes really can't go much lower than that, guys. It's hard to compare this market in 2023, at the end of 2023, 2024. It's hard to really compare it with 2008, right? Some different issues going over there. Back then, you had subprime lenders and all these things going on, but you don't really have that right now. So it looks a little different. We may be in a bubble right now, but this bubble doesn't look like the bubble in '08, right? Right now, we have 10% more people in the American population, right, than we even had back in 2008, just 15 years ago. So there's more people. So demographics have changed a little bit. And so things are a little bit different, right? Now, let's dig a little deeper, guys. According to Redfin, a national real estate brokerage, right, where they collect a lot of data and put out a lot of data, home prices, what homes actually cost nationwide. Let me actually share that screen with you guys real quick. So according to Redfin, home prices, what homes actually cost, was up 2.9% year over year, right? And I'll make that a little bit bigger so you can see it. Up 2.9% year over year, okay? And so what that means, guys, is that, that's in August, by the way. That's our latest data is August. At the same time, let me just kind of keep going. At the same time, the number of homes that sold actually fell 13% year over year, right? So less homes are selling. Now, the number of homes for sale that were actually out there for sale on the market also fell nearly 16% at 15.8%. Now, of course, guys, This is our supply issue. Why did these numbers fall so steep? Well, it's because of high interest rates, right? These high interest rates, as the Federal Reserve is continuing to raise the federal funds rate, which trickles down to the mortgage rates. It trickles down to the U.S. Treasury, and that, of course, trickles into the mortgage rates. But let's keep going. The median price, the middle price, median being middle price for a home was actually up 3% to $420,284 year over year, right? Since in August of this year. Now, some other really interesting stats leading to why I say that a crash is probably coming and why we shouldn't buy yet is the interest rates are hovering so high. Now, let me share this with you. Now, when you look at mortgage rates, guys, the rates of interest right now, we're talking today, October 10th, 30-year fixed, over 8.3, and that's with a 7 to 720 credit score, right? In the state of Missouri, on a $300,000 loan that's 30-year fixed is over the 8% mark, 15-year being 7.5 almost. But guys, with interest rates hovering at so high, we're in a possibility of higher mortgage rates coming up because we know that the Fed is going to meet in a couple of weeks, 3 weeks, and the Fed is going to say, oh, we're going to raise the Fed funds rate again. Now, that's going to ultimately put more pressure on the bond market, which puts more pressure on the Treasury, the 10-year Treasury, and ultimately that is what trickles down and determines the mortgage rate. So we could see mortgage rates go higher if the Fed decides to raise interest rates again. So, guys, to finance a home is very, very huge, right? Higher interest rates means higher payments, which higher payments knocks a lot of buyers out of the housing market, right? The difference between a 3% 30-year fixed and an 8% 30-year fixed is about $900, right? Almost $1,000 a month on a $300,000 or $400,000 home. That's a huge payment increase. So high mortgage rates are a big time problem for buyers. About 92% of all current mortgages, guys, in America, 92% have an interest rate of under 6%. Right? So most folks have lower interest rates, and about 83% of all mortgages in America are under 5% interest. And about 25%, get this, 25% of all mortgages in America are under 3%. That's a quarter of all mortgages that are super duper low mortgage rates. Who's going to want to get rid of that 3% or that 4% mortgage for an 8% mortgage or a 15-year fixed at 7.5%, right? Nobody's going to do that. So homeowners are bunkered in. They're not really moving. They're not really selling, right? Again, the only people selling are the people that have to sell. People are staying put. And these people that are staying put, by the way, they may end up losing some equity as home prices come down just a wee bit. If home prices come down just a little bit, you're going to see a lot of folks losing some equity in their homes because prices will go. That $400,000 home was going to go down to $350,000. You're going to lose some equity. Now, all of this is also hurting home builders, right? This is probably who got hit first many months ago was the actual home builders because they are building new homes, building new apartments, and those new homes are sitting empty. So home builders, they want to add inventory to the market as well, and they want more supply to supply more homes to the housing market, obviously. But if there's no demand for new homes, then guess what? Home builders are going to be hurt real bad, and they're being hurt right now. Now, I mentioned the median home price of $420,284. According to the Census Bureau, the average new home sold in August in America was $513,000. And if you put a 3% down payment on a $513,000 house, that's about $23,000 if you add in closing costs and all that good stuff. At a 7.5% mortgage interest rate, guys, that's a $4,700 payment. Who can afford a when you add in taxes and insurance and escrow it all in, who can afford a $4,700 mortgage, right? Not many people. If you're not making $100,000 a year, you're probably going to have a hard time buying a house right now because you're pushing up to the debt to income ratios that's out there. And so just think about that, guys. Mortgage rates drive mortgage payments incredibly high. New home construction's down. We know that. And it's hitting younger buyers, as we said, the millennials and people that are younger who want to be first-time home buyers. It's hitting them even harder because they make less money. So the question is, what's the Fed going to do, right? The Fed will likely raise funds rate for short-term loans. Perhaps, right? Now, the markets are not pricing that in. The markets are saying the Fed probably won't raise rates because they don't want to mess with the bond market. They don't want to mess with the housing market, right? They don't want to do all those things. So the Fed will probably pause. So we'll see what happens, right? The Fed has raised the Fed funds rate by a total of 525 basis points, or 5.25 percentage points, since about March of 2022. So mortgage rates have risen by smaller amounts, right? 4 or 5 percentage points, but still plenty when you go from 2% to 6%, 2% to 8%. Because at the beginning of 2022, mortgage rates were around 3.2%, 3%, right? And now at the end of 2023, mortgage rates, again, as I show you right here, guys, or I showed you, mortgage rates are buttoned up at 8%. Mortgage rates are influenced by a lot of things. Now, let's keep that in mind, okay? Inflation rates, job creation, all types of things, right? Whatever the Fed's monetary policy is at the point. And so all of these things affect what happens to the mortgage rates. Now, the thing is, there's a lot of people out there, guys, that are eager and waiting for this sort of low supply to go away. And they're waiting for interest rates to come down. But purchasing power is incredibly low right now. Okay. Purchasing power is incredibly low. Let me show you this chart real quick, guys. So what this chart shows, guys, is how much home you can afford as mortgage rates change. It shows the home price you could afford for different monthly amounts based on the mortgage interest rates. And it assumes 20% down, 30-year mortgage, and some property tax and homeowners insurance escrowed in. Now, so in other words, if you wanted to keep your payment at $1,000 and rates was 3%, you could afford a $207,000 home. If you wanted to keep a $1,000 mortgage rate and rates were at 8%, you could only afford a $136,000 home. That's like 70-something thousand. Guys, that's almost 80,000 less in home. Let's bump that up a little bit. Let's say you want to have a $3,000 payment. And at a 3% mortgage rate, a $3,000 payment, you could afford a $621,000 home. But if you wanted to have a $3,000 payment at an 8% interest rate, then guess what? You could only afford a $409,000 home. Guys, that's $200,000 difference. That makes a huge difference in the type of home that you could actually qualify, or not qualify for, but that you could actually live in based on your payment. Incredible, right? So we think interest rates, a point or two or 3 or 4 doesn't make a big difference. It makes a huge difference when it comes to what you can afford and the affordability. Going back to the very first thing I said, the affordability of homes right now is incredibly low, right? So here's the deal, guys. We need to figure out, bottom line, prices may dip, okay? Prices may dip and go down. And when prices dip and go down, are you going to buy, even though rates may still be high when those prices dip? Right? The days of low prices and low prices on homes and low interest rate, those days are over, right? Something is going to have to give. This is why I say don't buy a home just yet. Either prices have to come down or rates have to come down, right? So that's just very important. Let me also show you this one article here, guys. This article here points out what recently took place that I thought was really interesting, that kind of hit the back page of the newspapers, but it probably needs to be on the fronter page of the newspaper, or the front page, right? Because this is really important. The housing industry is urging, right? The housing industry is urging the Fed to not raise rates. The National Association of Home Builders, the Mortgage Bankers Association, and the National Association of Realtors, right? They all got together and wrote the Fed and said they wanted to send a profound message about the industry. And the message was, they asked the Fed not to contemplate further rate hikes and not to actively sell its holdings of MBSs, mortgage-backed securities, right? So these top real estate and banking officials are calling on the Federal Reserve to stop raising rates as the housing industry suffers through surging housing costs and historic shortages, right? Historic lows in inventory. In a letter back on Monday, a few days back, addressed to the Fed Board of Governors and the chair, Jerome Powell, the officials of those organizations voiced their worries about the direction of the monetary policy. And basically what they're saying, guys, in this article is, we need you to stop raising interest rates because it's destroying the housing industry. And we're going to be in for something that we are not prepared for as an industry. That's a really important thing to note, guys. That article right there is clear evidence of the industries that are involved and hurt by the federal funds increasing rates, the housing industries expressing how they, don't think it's a good idea for their industries to continue to raise rates. That's their plea to the Fed. Now, what is the Fed going to do? That remains to be seen in the next few weeks. Guys, I just wanted to give you guys a warning to say, hey, we're in for something pretty impactful with this housing market. And I want to keep you guys aware and informed, like I always do on this channel, about what's happening. Guys, do me a favor. Be sure to smash the like button below. Also, share this video with someone who may be looking to buy a home sometime soon, and giving them this kind of heads up and this warning that they need to be looking at these things if they're making a purchase or considering a purchase in the next, say, year or so, right? Let me know what you guys think in the comments below about mortgage rates and the housing market. What you think it's going to do in the next, say, few months, 6 months or so. What do you think the Fed is going to do, and how do you think that's going to affect the ultimate outlook of mortgage rates and the housing industry? And I'm going to try to keep you guys up to date even more about this issue on this channel, because, hey, the channel is all about helping ordinary people be extraordinary with their money. Guys, listen, the best person who's going to take care of the old you is the young you. Do me a favor. Take care of yourself and take care of other people. Until the next video, peace.